Bitcoin and the broader crypto market move in predictable 4-year cycles driven by halving events. And understanding these cycles is the difference between buying the top like retail investors and accumulating at the bottom like institutions. While most people get caught up in daily price movements and emotions, professional investors use systematic frameworks to identify market cycle phases and position accordingly. In this comprehensive guide, I'll teach you the institutional approach to crypto market timing that helps you buy fear, sell greed, and build wealth through complete market cycles. Crypto markets move in predictable cycles driven by fundamental supply and demand dynamics, not random price movements. The 4-year Bitcoin cycle structure. Bitcoin's market cycles are anchored by halving events that occur approximately every 4 years. Halving event, Bitcoin mining rewards cut in half, reducing new supply shock. Reduced supply meets existing or growing demand, price discovery. Markets adjust to new supply-demand equilibrium. Market psychology. Human emotions drive price beyond fundamental value. The 4 phases of each cycle. Every crypto market cycle contains 4 distinct phases. Phase 1, accumulation, bear market bottom. Duration, 6 to 12 months after major crash. Characteristics: despair, capitulation, low volatility, institutional accumulation, price action, sideways movement with occasional sharp drops. Sentiment, maximum pessimism, crypto is dead narratives. Phase 2, early bull market recovery. Duration, 12 to 18 months leading to halving. Characteristics: slow, steady price increases, disbelief, smart money. Entry, price action, higher lows, breaking key resistance levels. Sentiment, cautious optimism. Is this real? Questions. Phase 3, late bull market, euphoria. Duration, 12 to 18 months post-halving. Characteristics: parabolic moves, mainstream adoption, retail FOMO, price action, vertical price increases, new all-time highs. Sentiment: everyone is a genius, maximum greed. Phase 4, distribution and crash, bear market. Duration, 6 to 12 months of decline. Characteristics: reality sets in, leverage unwinds, mass liquidations. Price action: 70-90% decline from peak, volatility spikes. Sentiment: denial, anger, capitulation, historical validation. This pattern has repeated consistently. 2011-2015, first documented cycle. 2015-2018, classic cycle with ICO boom bust. 2018-2022, institutional adoption cycle. 2022-2026, current cycle, institutional maturation. Understanding what drives these cycles helps predict their timing and intensity. Primary drivers: Bitcoin halving events, the most predictable catalyst in crypto. Reduces new Bitcoin supply by 50% instantly. Historical halvings: 2012, 2016, 2020, 2024, next 2028. Creates supply shock that takes 12-18 months to fully manifest. Each halving has preceded major bull markets. Institutional adoption waves. Different institutions enter at different cycle phases. Bear markets, sophisticated funds and early institutional adopters. Early bull, traditional finance firms and corporate treasuries. Late bull, retail institutions, pension funds, sovereign wealth. Each wave brings new capital and legitimacy. Regulatory clarity cycles. Government policy often follows market cycles. Bear markets, harsh regulation, crackdowns, uncertainty. Bull markets, clearer frameworks, institutional-friendly policies. Policymakers reactive rather than proactive. Regulatory clarity often coincides with institutional adoption. Technological development. Innovation cycles align with market cycles. Bear markets. Builders focus on technology, infrastructure development. Bull markets. Applications and user adoption flourish. Each cycle brings new technological capabilities. Innovation during bear markets powers next bull market. Secondary drivers. Macroeconomic environment. Traditional markets influence crypto cycles. Low interest rates. Risk-on environment favors crypto. High interest rates, risk-off environment pressures. Crypto inflation concerns. Bitcoin digital gold narrative strengthens recession fears. Flight to quality affects crypto adoption timing. Media and sentiment cycles. Information flow follows predictable patterns. Bear markets, negative coverage. Crypto obituaries, bull markets, mainstream coverage, celebrity endorsements, social media sentiment leads and follows, price Google search trends correlate with market phases. Professional investors use systematic frameworks to identify where we are in the current cycle. Quantitative indicators, on-chain metrics, MVRV ratio, market value to realized value indicates overvaluation, SAGE, undervaluation. NVT ratio, network value to transaction ratio shows if price matches usage. Active addresses, user adoption and network activity trends. Exchange flows, net inflows, outflows indicate accumulation distribution. Technical indicators, 200-week moving average, long-term trend direction PI cycle. Top, mathematical model for cycle peaks, stock-to-flow model, supply scarcity relative to price, PUL. Multiple, mining profitability and selling pressure, market structure indicators, volatility patterns, low volatility in accumulation, high in distribution. Volume. Analysis, distribution patterns across cycle phases. Correlation, analysis, how crypto moves relative to traditional markets. Liquidity analysis, market depth and institutional participation. Qualitative indicators, sentiment analysis, fear and greed. Index, emotional temperature of markets. Social media, sentiment, Twitter, Reddit, Telegram activity patterns. Google Trends, search volume for crypto related terms. Media coverage, quality and quantity of mainstream coverage. Institutional behavior, corporate adoption, companies adding Bitcoin to balance sheets. Fund flows, ETF and institutional product inflows, outflows. Regulatory developments, government and regulatory body actions. Infrastructure, development, professional trading and custody solutions. Developer activity, GitHub commits development activity across major projects. Protocol upgrades, major network improvements and launches, DeFi innovation. New protocols and total value locked trends. NFT and application development, consumer-facing innovation cycles. Institutional investors use systematic approaches to position across market cycles rather than trying to time exact tops and bottoms. Strategy 1. Dollar cost averaging with cycle awareness. Enhanced DCA that adjusts based on cycle phase, bear market. Increase allocation during maximum pessimism. Early bull. Maintain steady accumulation as trends confirm. Late bull. Reduce allocation as euphoria increases. Distribution. Minimize or pause accumulation during obvious bubbles. Implementation. Set base monthly investment amount. Multiply by cycle phase factor 0.5x to 2x based on indicators. Use multiple timeframes, daily, weekly, monthly. Automate execution to remove emotional decisions. Strategy 2. Cycle-based rebalancing. Adjust portfolio allocation based on cycle phase. Accumulation phase, 80% crypto, focus on Bitcoin and blue chips. Early bull phase, 70% crypto, add promising altcoins. Late bull phase, 40% crypto, take profits systematically. Distribution phase, 20% crypto, preserve capital in stable assets. Strategy 3. Fibonacci retracement timing. Use mathematical levels for entry and exit decisions. Bear market bottoms often occur at 78.6% or 88.6% retracements. Bull market corrections, 38.2% and 50% retracements offer entry points. Distribution levels, 161.8% and 261.8% extensions indicate potential tops. Combined with cycle analysis, Fibonacci levels more reliable within cycle context. Strategy 4. Sentiment contrarian position opposite to prevailing market sentiment, maximum pessimism. Increase allocation when others capitulate. Mainstream euphoria, reduce allocation when everyone is buying, use quantified sentiment, don't rely on personal feelings. Gradual implementation, scale in out rather than all or nothing moves. Strategy 5. Multi-Timeframe cycle analysis. Analyze cycles across different time frames. 4-year major cycle. Primary strategic positioning. 1-year seasonal patterns. Quarterly rebalancing opportunities. Monthly patterns. Short-term tactical adjustments. Weekly patterns. Execution timing. Optimization. Different market cycle phases require different risk management approaches. Phase-specific risk management. Bear market risk management. Opportunity cost risk. Missing accumulation opportunities. Knife catching risk, buying too early in decline. Liquidity risk, maintaining cash for extended periods. Strategy, dollar cost average, maintain high cash reserves, focus on quality assets. Bull market risk management, overallocation risk, becoming too concentrated in crypto FOMO. Risk, chasing performance and making emotional decisions. Liquidity risk, markets can turn quickly from bull to bear. Strategy, systematic profit taking, maintain diversification, set stop losses. Transition risk management, whipsaw risk, false signals during phase transitions. Timing, risk, being too early or too late in phase identification, execution. Risk, unable to implement strategy due to market conditions. Strategy, use multiple confirmation signals. Scale in, out gradually. Portfolio construction, across cycles. Dynamic asset allocation, adjust allocation based on cycle phase and personal risk tolerance. Conservative, 10-30% crypto maximum allocation. Moderate, 20-50% crypto with cycle-based adjustment. Aggressive, 30-80% crypto but still cycle-aware. Cross-asset considerations. Crypto cycles don't happen in isolation. Traditional market cycles, how stocks, bonds affect crypto timing. Commodity cycles, gold and Bitcoin correlation patterns. Currency cycles, dollar, strength, weakness impact on crypto real estate cycles, alternative asset allocation timing. Psychological risk management. The biggest risk in cycle investing is emotional. Planning phase. Make decisions when emotions are neutral. Execution phase. Follow predetermined rules regardless of feelings. Review phase. Analyze decisions objectively after completion. Accountability. Use systematic approaches and external validation. Altcoins follow Bitcoin cycles, but with their own patterns and timing variations. Altcoin season patterns. Altcoins have predictable behavior relative to Bitcoin cycles. Early bear. Altcoins crash harder than Bitcoin. 80-95% declines. Late bear. Quality altcoins begin outperforming Bitcoin. Early bull. Bitcoin leads, select altcoins follow. Late bull. Altcoin season. Massive outperformance versus Bitcoin sector rotation. Within cycles, different crypto sectors lead at different times. Infrastructure. First, layer 1's scaling solutions, infrastructure DeFi. Second, decentralized finance protocols and tokens. Applications. Third, gaming, NFTs, consumer applications, speculation. Last, meme coins, microcaps, pure speculation. Timing. Altcoin. Allocation, professional approach to altcoin timing. Bear market, focus on Bitcoin and maybe top 2-3 altcoins. Early bull. Add quality layer 1s and establish DeFi mid-bull. Diversify into various sectors and promising applications. Late bull. Consider speculative plays but with strict position sizes. Quality versus speculation timing. Different standards for different cycle phases. Bear early bull. Focus on fundamentals, proven teams, real utility, mid-bull. Balance fundamentals with growth potential. Late bull, speculation acceptable but with tight risk management. Distribution, return to quality focus, prepare for next cycle implementation framework. Use Bitcoin dominance as altcoin timing indicator. Monitor sector-specific metrics. TVL for DeFi, uses for applications. Track narrative development and institutional interest. Apply same risk management principles across all altcoins. Create a systematic approach to crypto cycle investing that removes emotion and improves outcomes. Step 1. Cycle phase assessment. Develop your own systematic framework. Choose primary indicators, 3 to 5 quantitative metrics you'll track. Set phase criteria, specific values that indicate phase transitions. Create scoring system, weighted average of all indicators. Regular review schedule. Monthly assessment of current phase. Step 2. Allocation framework, design allocation rules for each phase. Define risk tolerance, maximum crypto allocation you're comfortable with. Phase-based adjustments, how allocation changes by cycle phase. Asset selection rules, which cryptos to hold in each phase. Rebalancing triggers, when to adjust positions. Step 3, execution system, remove emotion through systematic execution. Predetermined entry-exit rules. Clear criteria for buying, selling position. Sizing formula, mathematical approach to investment amounts. Automated execution, use technology to implement decisions. Emergency protocols, what to do if system breaks down. Step 4, performance tracking. Measure success across complete cycles. Risk-adjusted returns, performance per unit of risk taken. Cycle-based analysis, how well you captured each phase. Benchmark comparison, performance versus buy and hold strategies. Continuous improvement, lessons learned and system refinements. Common implementation, mistakes. Over-optimization, trying to time exact tops and bottoms. Under-diversification, concentrating too heavily in single assets. Emotional override, abandoning system during emotional periods. Insufficient patience, expecting immediate results from cycle timing. Success factors, long-term perspective. Think in 4-year cycles, not daily moves. Systematic discipline, follow your rules regardless of market conditions. Continuous learning, adapt system based on new information. Risk management, preserve capital for next cycle opportunity. Understanding crypto market cycles is one of the most powerful frameworks for long-term wealth building in this space. While you can't time markets perfectly, you can position intelligently for each phase. Here's how to implement cycle-based investing. First, subscribe to this channel for more institutional-level crypto education that focuses on systematic long-term approaches to cryptocurrency investing. Second, start tracking cycle indicators now, even if you don't change your allocation immediately. Understanding where we are in the cycle is the first step to positioning appropriately. Finally, share in the comments where you think we are in the current crypto cycle and why. Whether you see signs of accumulation, early bull, late bull, or distribution, explain your reasoning. Remember, The goal isn't to perfectly time every move, it's to position appropriately for each cycle phase and capture the majority of long term upward moves while avoiding the worst of bear market declines.